Hello and welcome to The Big Picture with me, Ishan. Today we focus on the US Federal Reserve rate hike and its impact on emerging economies, especially India. First, let's apprise you of the situation that being the US Central Bank raised its benchmark federal funds rate for the first time in more than 9 years on Wednesday. The rate had been next to zero since December 2008 and was increased by a quarter point to a range of 0.25 to 0.50%. Now, the move affects everything from capital flows to stock markets to exports and a whole lot more. So what will be the impact of this rate hike, especially on emerging economies like India? To answer that question, I am joined by Dhirendra Kumar, Head of Value Research, Mohan Guruswamy, Senior Economist, Senior Journalist Priya Ranjan is also over here with us. Mr. Guruswamy, I'll start with you. As far as the need for the US Federal Reserve to do this rate hike, let's understand that and the implications that it has for the global economy.
Well, the implications for the global economy is that it will start sucking back money to the American market. 0.25 by our standards is nothing, but by the US Fed standards, considering for 9 years it was zero.
Yes.
0.25 is a lot of money. And this is the beginning of a process. Matter of fact, I saw a study by the Congressional Budget Office which says that in the next 10 years, this will suck in $2.9 trillion into the United States. Right. So it's not a small, and US is a healthy economy. It's growing. Last quarter, it grew at almost 4.9%, which is as good as India's. If right. you adjust for deflation, we are about there, and in real GDP terms. So nominal at least. So this is going to pull out a lot of money. So what it is going to do is slowly start taking money out of the capital market. You know, out of money available for investment in India will also be tight. So it has implications. Why is the US doing it? I think, you can't go forever without paying interest because it has bearing on bank rates and people keeping money in banks and things like that. And, the confidence they feel in the economy that, they can take money in banks and give people higher rates. Otherwise, you get into instruments which are risky.
Okay.
So it's also protecting their own citizens. There are too many bank failures in America. So I think it has implications, not something to be wished away. And the Chinese economy has slowed down. They're going to get hit. Brazilians are inflating at a very high rate. They're going to get hit. A country like India, if we continue to post 7% GDP growth rates in real terms, then we'll be kind of insulated against this. Otherwise, we'll also get hit.
Okay, fair enough. Mr. Dhirendra Kumar, but the stock markets were quite wary, but given the fact that this rate hike was impending for some time, the markets today seem to have absorbed that. And how do you see that impacting investment flows into India?
No, one is that, investment flows from FIIs have definitely decelerated in anticipation of this. And there was absolutely no surprise with this rate hike because this was so widely anticipated that there was absolutely no surprise. At the same time, the whole pointer or indication that rates will rise there gradually was also very much in line with that. So I don't think the market was, jittered. But more importantly, what has happened in the Indian market that we have seen a big resurgence of the domestic savings getting channelized into the market. Last 1.5 to 2 years, we have seen, about a year and a half back, we had domestic investors who were actually pulling out from the market. Domestic investors were pulling out from the Indian equity market. That situation has reversed completely. So what we have seen right now is 1 lakh crore of domestic flows into the market, and that is able to balance all the FII outflow. That is perhaps the reason why we have seen a very resilient domestic market.
All right, so that insulation, is it good enough for India? As Mohan Guruswamy is saying, in the long term, it could have an adverse impact, but in the short term, India seems insulated. Priya Ranjan?
Well, I won't call it insulated because the damage has been done or the impact has already happened in anticipation of the event. But this time, if you go back to June 2013, when the US Fed announced that they announced a calendar for the withdrawal of the quantitative restriction and the huge impact it had in terms of our market on the value of rupee, which 25% devaluation almost because of that. So considering if you compare the two situations, this time since it's been more orderly, number one. And the impact has already happened in anticipation, not only for our market, like Dhirendra was mentioning, it is, this year alone, $500 billion have been withdrawn from emerging markets. Now that we have come to the end of the year and after January, when you have reallocation of resources, and since there is a certain amount, the uncertainty is gone in the sense that the Federal Reserve chairperson has also said that the future rate hikes would be gradual steps and in a more orderly manner, looking at the recovery of the US economy, the strength that it gathers. To that extent, the impact is well cushioned. Number two is, of course, compared to, say, the situation in 2013, there are several areas of strength at the moment. I'm talking about immediate and the short-term impact that is. So, in that sense, from 6.8% of GDP, which was your current account deficit in 2008, you have a current account surplus at the moment. Number two, your inflation, which was running berserk almost, is well within control, and the Reserve Bank of India January target, even though CPI inflation has been inching up, it is still within the target. And the most important thing is, as Mohan was mentioning, the economy is growing at over 7%. And
in nominal terms.
Yes,
real
of
terms.
course, nominal terms.
Real terms.
Yeah.
Nominal is 5.
Yes. No, means the nominal is, because we have had
deflation.
for the latest period the deflation.
Right.
So the nominal, you should take that out.
So that's almost as much as the US is
the GDP deflator. So so that is, of course, means if you compare it to 2013 kind of a situation, where it was sub 5% growth, compared that to 7%. As long as you are growing at 7%, and you should be this, But see, there is a basic dichotomy that is between the Indian economic situation and the US or the global situation, which comes out of this Fed rate hike. Now, as Fed rate or the Fed rate would be inching up, they have said after 9 years. In India, we are trying to bring down
interest rates.
So this year, Reserve Bank of India has lowered policy rate by 125 basis points. The transmission has not been there, 60 basis points or so by the banks. But the Reserve Bank of India has been wanting to bring down rates further. Now, see, with the US rate hike, although inflation is within the Reserve Bank of India target, it creates a difficult, or I would say unease situation. Much would depend on what the government does to its fiscal situation.
The next year's budget would be critical in that nature. I'd also like to introduce Mr. S.K. Jindal. He is the chairman of the ASSOCHAM Investment and Investors Protection Committee. Thank you very much for coming in. Just from the industry's perspective, just to get your views on this subject on board, the US Federal Reserve rate hike, how does the Indian industry view this?
We are quite satisfied with the way preparations were done. RBI prepared us. The whole nation was prepared, and we found that finally it was sort of non-event, not much, anything negative didn't happen. So we are very happy about it. This kind of preparation, which is coming from the macros of our economies, were very strong. That helped us, because if you look at other emerging markets, not all of them have similar macros. They are affected also, but their effects, it is much more, and for us it was almost nothing. So we are happy that this kind of preparation was already in place, and there was no stability in the markets, and we are very proud that everything went off very well, and we will be able to take, we don't see any much instability and turmoil in the future as well. When this will happen in the next year, some more steps, similar steps will be taken. But we think we'll be able to handle them with stability. which is
so
very good for the markets.
Mohan Guruswamy, it turns out to be a litmus test really for the Indian economy, so to say, in terms of the figures that we're talking about. Also, as far as the rupee is concerned, there's been concern expressed about that as well, about the value of the rupee versus the dollar, given this Fed rate hike. So, help us understand the impact of that.
You see, this is just the first step, 0.25. The target is to take it up to 2% in the next year and a half. So that's what is becoming apparent now. They'll take it up step by step. Every quarter they'll announce a little rate increase. Now, the impact on this will be on our NRI deposits. $120 billion sitting in part of our reserves in this hot money. And they're operating at this 1.5 to 2% spread. So when interest rates in American banks go up by 1.5%, the spread becomes very thin, the risk becomes great, so the money will fly. So this is one risk. FII money will certainly be affected because, the American market will just keep pulling it in. There are other impacts also. The higher interest rate in America will also slow down the higher purchase business in America. So automobile companies are expecting a drop at 0.25% of 150,000 vehicles next year. At that rate. So that means, we are big exporters of auto parts.
Right.
So, we'll have downstream effects. When credit card money becomes more expensive, when, higher purchase becomes more expensive, American economy also, because 5% is too hot for them. They're also trying to slow it down. So I think there are going to be effects. And the thing is to be prepared for this. How are you going to close that gap of $120 billion? Be prepared for it.
Okay.
Because that's hot. And we've got used to that hot money be sitting here. And the NRI interest is vested because they make money out of it. So there's huge song and dance about these guys. It'll be proof of their patriotism in quotes, Right. How many will stay? I think this money will fly out because it's borrowed from American banks. So I think there's going to be serious repercussions for us and we have to be prepared for it. Can't be sanguine, saying that, everything is all right. Because, our economy is not growing at 7.4%. It's growing at 5% in real terms, in nominal terms. So, you can fool yourself. You can delude yourself. But, you've got to be ready. Current account deficit is down because, imports have come down.
Yeah.
Because the economy is slowing down as a whole. So, I think, one has to be very careful and watchful because the US is still the driver of the world's economy. It can, when it grows, we get hurt. When it slows down, we get hurt. And if it doesn't consume, also we get hurt.
Okay.
So I think we want to watch it very carefully.
All right, Dhirendra Kumar, I will put that question to you that I had put to Mr. Guruswamy about the rupee and the concerns expressed with that. The rupee turned out to be a little more resilient today as far as what the numbers have come in. But in terms of short-term or long-term impacts on the rupee, how do you see this impacting?
No, certainly, our, exports it'll have a implication on that. And but more importantly, the way I look at it, we are going to looking at the final analysis. Of course, we have to see that how things really pan out. The indications are that interest rates in the US will go up steadily, and it is unlikely to go up in a hurry because they also have to take a relative view. You have, a large economy, large economic region, the Euro, where you have, a zero or a negative interest rates in many regions. So from that standpoint, it is unlikely that, it will happen in quickly. We will have successive rate hikes. So that itself is, rates going up steadily will provide relative stability. The other important thing is that in the, if we look at the globe, where are we going to witness the, where will the economy be growing faster? And on that standpoint, I think we are very fortunate to have an economy getting into some form where we are still in the positive territory and a handsome number there. That apart, I think even on the corporate cycle, we are at a situation where many companies are actually fixing their, fixing themselves financially. And we are still not out of woods on that front. But I hope that 1.5 years, 2 years, we will have our growth back, and that is the time when a lot of this money, the hot money will also try and chase performance, And from that standpoint, I think we are likely to be a very attractive destination. So we are unlikely to be very hurt, badly hurt by the emerging situation.
Okay, Mr. Jindal, as far as exports are concerned, now that is one area where India has been registering a consistent fall. How do you see this impacting that particular sector? Because while many would say that the exporters would get more money, but in terms of, as Mohan Guruswamy had pointed out, the downstream effects of this rate cut could impact exports.
My view is that it will impact positively. If economy on the other side is good, US economy, then they will be having more buying power from us. Our exports were suffering quarter after quarter, month after month, reason being that they didn't have the buying power, Europe, US, etc. Because if the economy improves there, this will help us also in our exports. And there are pluses and minuses. If their economy is doing good, then our IT sector, it will also improve. They will have more possibilities of better profitability there. So all these things, we need to work very hard. That remains. As long as we work, we do our homework and we work hard, nothing can beat us. But if we don't work ourselves, then all these things start affecting us badly. So it is very important that we should keep our macros very strong and at the same time work very hard, and then we can handle all of them easily.
All right, so Priya, it turns out to be a test of India's macroeconomic credentials, doesn't it? But as far as exports are concerned, how do you see this? Because would you agree with Mr. Jindal that we're in a positive situation as far as exports because of this Fed rate hike?
Well, yes. Means insofar as the US market is concerned, if the Fed rate hike indicates that the economy, US economy is doing well, then in terms of US being an export market for us, that surely opens up, or creates better opportunity after so many years. Because our exports have been under pressure because of two factors normally. We see because of our commodity orientation in the export basket. For instance, petroleum products, which have of late been, last 5 years or so, have emerged as the #1 item in our export. Now, there what has happened is the oil prices have collapsed. So the refined petroleum products that we export, naturally their value has collapsed. That is given, so the export fall that we have seen for the last 9 months looks more accentuated because of the fall in value rather than so much in volume. There is, of course, sectors where there has been a volume fall. That is primarily because the buying markets have been weak and sluggish. That's been the case. Now, in terms of the Fed rate hike and its impact, I would say that rupee would be under pressure to the extent that although inflation is well under control, 6% is not a, internationally speaking, is not a low rate of inflation, but insofar as we are concerned, we consider that to be the target rate. So in that sense, CPI inflation is under control. Although it's under control, rupees would be under pressure. And rupee, as we know, the real effective rate of rupee is perhaps something around 70 to a dollar. And so, it's some amount of correction is required. To that extent, that too would help exports.
Okay. And is that correction, is that the RBI going to take that step? Because some people have been saying that the RBI might step in to save the rupee.
Unlikely, but they will let it slowly drift to that position. But I think the big challenge for us is going to come from the flight of capital. One is the FIIs, two is the PIO, NRI bank accounts.
Right.
Third, illicit transfers last year were $51 billion, according to Global Financial Integrity Index. $51 billion is a lot of money. And if you're going to get interest there, more money will run. So, one has to be extremely careful about halting flight of capital, or also shoring up your reserves, building up reserves. Building up reserves means foregoing some infrastructure costs. So there are going to be effects. Because one has to study this, take a holistic view of this. It's not something, which I'll weather and, say with determination. One, there are going to be costs. And we'll have to be prepared for those costs.
Okay. Final comments, gentlemen. Dhirendra, Kumar, I'll come to you first. So, in a real sense, I mean, I've been using this term all through the show about this being a real test of the Indian economy and our growth rate and other such things, our reform measures and the confidence that people investing in India would really have in India, isn't it?
Yeah, absolutely. I think, of course, it is a matter of concern that, the loose monetary policy globally, we could have been a bigger beneficiary in the last decade. But at this point, I think we have been able to get our act together. And if you look at, the state of rupee, imagine what it would have been if, fortunately, given the kind of, we haven't seen any turmoil in the markets globally. This is unlikely to impact the way the gold prices go up and the way investors, move towards gold in uncertain times. So it has not caused any havoc or uncertainty. The Indian government taking some steps in the last, 6-8 months, and that is translating into something meaningful. And gold prices also softening is helping us. So that was our second largest, import component. So on that front, we could be very lucky. Then comes, the state of our domestic economy and particularly the corporate sector. And there, I think, we have some significant thing waiting in the wings. We could be in for a big turnaround. Some symptoms are visible. And I think a good part of the manufacturing economy getting back on track, as interest rates locally actually go down, we are virtually seeing a reversal which could be very favorable to us. So I think, we could be in for some very, a big phase. Our markets haven't gone anywhere in the last 7-8 months. If you look at the January 2008 peak,
right,
we are still quite, substantially lower, and the market has undergone a big rejig. Our banking sector is still in the dumps. So we are witnessing some kind of, a good part of our economy might be in for a big turnaround and a re-rating of the Indian market. And relative to, all parts of the globe,
right,
we could be a very attractive destination, and all this thing will translate into money coming back substantially once again.
Okay, Mr. Priya and Ranjan, that's final word to you. How do we see this impacting the budget?
See, broadly, means overall, this is, this is tightening of monetary policy in the US. Now, since the financial crisis, or even a little before that, since 2006, there has been a lot of monetary easing and so many, trillions of dollars flushing around. And that has come to the markets, including ours. We haven't been able to take much advantage of it. And that phase, now it is being signaled that is being withdrawn. So I would, if you take a longer term view, then what Mohan is suggesting, that's a clear danger one should be aware of. So looking at that, if you look at the budget, what one is to look at, see, there is the urgency of sticking to the roadmap couldn't be any more than now it is. So this year, only yesterday, Finance Minister has told Rajya Sabha that he is on track so far as the fiscal targets this year is concerned. And one hopes that he sticks to the fiscal target, the roadmap for next year. And but, as we know, the seventh pay commission has come, 1 lakh crore of impact now, and the disinvestment
has not happened at the pace at which
that is not happening. So all the cushion that is deriving out of the oil prices being low, that should be taken advantage. But there is much to be done to set his
final.
I think the key thing is that just don't look at fiscal deficit alone. Look at savings rate. Think of ways of getting it up. It's down to 33% from 38%. Look at investment to GDP ratio. That's also falling. Get it up.
Right.
No, you got to think of ways of that. You just can't be focused on managing the books.
Okay.
You got to look at the bigger picture also.
All right, so real test for the Indian economy, Mr. Jindal. I'm sorry you run out of time, but thank you very much for coming in, as well as Mr. Mohan, Guruswamy, Priya, Ranjan Das, and Dhirendra, Kumar, to help us understand. So real test for the Indian economy lies ahead. We here at Rajya Sabha TV will keep a close watch on that for you as well. But thanks so much for watching for now.